Welcome, this is Ike Hoffman with Tactica Real Estate Solutions, and today I'm going to show you how to create from scratch a sell versus refinance analysis template. There's many struggling real estate projects out there right now that have been affected adversely by rising interest rates combined with struggling property operations. For projects with floating rate debt and interest rate caps coming due soon, investors are going to feel some pressure and ultimately they're going to have to make a difficult decision. Sell into a declining market or refinance into a high interest rate mortgage. The simple model I plan to build today is going to focus on three things. First, what happens if we sell? What will the property deal metrics look like? The second thing is the potential for a capital call. If the refinance proceeds aren't enough to take out that original bridge loan, what would be the implications of a cash in refinance? And then finally, we'll look at the future cash flow projections post refinance, essentially looking at the cash on cash return with the new debt. If you're already a Tactica email subscriber, I'd be happy to send this analysis over to you. If you're not interested in building it, you just want to test it on your own deals, I'm happy to do that. If you're not a subscriber yet, there's a link below. You can subscribe to my email newsletter and you can just reply to the subscription confirmation and I'll get this over to you ASAP. If you've been enjoying Tactica's real estate analysis content, I'd really appreciate it if you like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Here's the scenario. We purchased a distressed multifamily project in 2021 and we're planning to do a major rehab. However, it's been tough sledding. The original pro forma projections have not been realized. The costs associated with the renovation have exceeded expectations. There's been a lot of surprise costs that have come up that we weren't anticipating. While there's floating rate bridge debt on this property, we do have a rate cap. However, that cap is going to expire in 6 months. We would be on the hook to pay a significantly higher interest rate each month. The property isn't yet stabilized. However, we expect it to be about 92-93% occupied within 3 to 4 months. As soon as that happens, we need to decide, do we want to sell it or do we want to refinance it? I already formatted this Excel workbook to save some time. So the first thing I want to do in this gray box here off to the left is I just want to record some of the historical information that has happened at this property since we've been owners. So specifically, I want to look at the purchase price, what our initial loan amount is, and if any distributions have been paid out either to ourselves or investors. So to do that, I'm going to create a sources and uses section over here. We'll do the uses first, and we're going to jot down things like purchase price, renovation capital, closing costs, financing fees, and then any sponsorship fees. So if you were like a GP charging an acquisition fee, you'd put that there. Purchase price of this asset was $13,500,000. Got a few zeros there. And then the renovation budget was $1,275,000. Closing costs, $125,000. Financing fees, there's a $97,000 financing fee paid to the lender, and there was an acquisition fee of $135,000. And then we can go ahead and total all of that. So the total cost basis was a hair over $15 million. And then for our sources, we had debt and equity. So the loan amount was for $9,700,000. That's our current bridge loan that we have on this property. It's a floating rate loan. Thankfully, we have that rate cap, so we're hedged. But once that rate cap expires, we will no longer be hedged, and that interest expense would be too burdensome. So that's why it's paramount. We decide if it makes more sense to sell or refinance. And then the equity is just going to be the difference between this $15.1 million cost basis and the financing. So we raised $5.432 million in investor equity, and then I can sum this section as well, and the sources and uses add out. The next thing I want to do is just note if there were any distributions. As I mentioned in the intro, this project has been below expectations. There's been no distributions. It's been just kind of a grind implementing the business plan. So let's just go ahead and we want to track 10 years. And if there's any distributions that you've paid out, you would enter those here. We've owned this asset for 2 years, haven't paid any distributions. So we're just going to plug in 2 zeros. The next thing we want to do is record what the stabilized NOI is. So I mentioned earlier, the property's not stabilized yet, but we're working towards that. And we're confident that in 3 to 4 months, that NOI is going to be $813,000. And this would need to be adjusted. This is probably the most important assumption in this entire model. So if you're trending above this expectation or below it, you should be changing it in real time so the model is reflective of that. And then we also need to make a cap rate estimate. So cap rates have changed. They've gone up in most markets around the country. And for owners, that's going to be a tough pill to swallow. But let's say today, if we were to sell it, we could do so for a 6% cap. And then I need to make a few more assumptions here. I'm just going to go ahead and copy and paste to save time. So the sale year, right? We've owned this asset for 2 years. We haven't paid any distributions yet. So we're looking to sell it in year 3. Those sale proceeds, what we would do to calculate that is we'd just take our NOI divided by the 6 cap, and that would be 13.55 million. And then we need to make a cost of sale assumption. So things like brokerage fees, legal, various closing costs. So I'm just going to take the sale proceeds and I'll multiply it by 1.5%. We'll say that there's about $200,000 of sale costs. And then the next cell is dedicated to sponsorship fees or loans. A sponsorship fee could be like a residual sale fee. I'm assuming though, if a property's struggling, a good sponsor is not going to charge a fee on a property that's not performing. I'd hope they wouldn't. There also might be some loans. So I've heard of instances where a sponsor basically, a project isn't going as planned. There's maybe more intensive capital needs than they had initially projected. So instead of like doing a capital call and raising more money from LPs, they'll plug their own money into the deal first, which I think is really admirable. It's a nice thing to do. But obviously, if they're putting their own money into the deal, they're going to need to be paid out before anybody else does, right? So they're basically giving the property like a 0% loan. I'm going to plug in 0. We're going to say that didn't happen in this scenario, but if it were happening in your project, you could enter in what that loan or sponsorship fee would be. And then the outstanding loan balance, this is an interest-only bridge loan, so it's the same as what it was 2 years ago, 9.7 million. And then their sale proceeds are going to be the 13.55 minus all of these other items, which gets us to about 3.65 million. So then we can come down here and we can actually record what these cash flows would look like so we can calculate some return metrics. Let's go ahead and we want to allow for up to a 10-year hold. The initial equity infusion was 5.4 million. And we just need to write a formula here that's dynamic for the future. So when we're changing assumptions in this model, the cash flows that flow into this section will update automatically. So I'm going to do an if formula. I'll say if the current year is less than our sale year, then I'll lock that cell. And if the year to the left here in the blue section is less than our sale year, we just want it to equal the distributions that we manually entered over in this gray section. And I will leave that cell unlocked because we're going to want to drag that down. And then I'm going to nest another if, and I'll say if the year equals the sale year, and I'll lock the sale year again, then we want the sale proceeds to flow into the model. And I'll lock that cell. Otherwise, just populate with a 0. Then I'll close both those brackets. And then I can drag everything down through year 10. So you can see we put in 5.4 million in year 0. There's no distributions. And then we'd be getting about 3.65 million back in year 3. And then we can calculate some return metrics quickly. So the total profit or loss, we'll just highlight this entire column. We'd be losing $1.8 million in this scenario. We can do an IRR calculation, so just equals IRR. And then grab everything from that column. So we'd be looking at a minus 12% IRR. And then finally, we can do an equity multiple calculation as well. So we'll just take all of the cash flows years 1 through 10, close the bracket, and divide it by a negative equity we put into the deal. And we get an equity multiple of 0.67. If we're confident that our stabilized NOI will be $813,000 and we could sell that NOI at a 6% cap, we would only get 67% of our initial equity back. We'd be losing a significant portion of that investment we made 2 years ago. We can continue with the refi section of our analysis. So the first thing we're going to do is estimate a cap rate at refinance. I'm assuming that's going to be the same as it is for the sale, but if you wanted to enter in something slightly different, you could do that. There's a few more assumptions we need to make in this section. It's a little more involved. The first thing, refi consideration year. Remember, it's going to be a sale or a refinance. So I'm just going to set that equal to our sale year. And that assumption then we're making in cell F6 will flow over to I6. And then the NOI annual escalator. So we're going to look at how our cash flow will look after we go through with the refinance. So we need to put in a percentage increase here. My thought process is if you're going to continue to hold the asset, hopefully for the long term, you're doing it because you think that the property is going to be well situated in 5, 6, 10 years from now. And we kind of want to see then how that NOI will change, which will directly impact the cash flow. And then we need to make our financing assumptions. The first one is the refi at LTV. You can't get high LTV like you could, during 2021 and 2022. No more 80% LTV. That's incredibly rare now. So we'll put in 60% for now. And then for our loan amount, we'll take our NOI divided by our cap rate times 60. And we have a refi loan amount of $8.13 million. Let's just finish up our debt assumptions here. We'll say that the proposed interest rate is 6.75%. The amortization is 30 years. The loan cost is 1%. So then our refi proceeds will be our new loan amount minus our original loan amount, and we get a minus 1.57 million. This means that we don't have enough loan proceeds to blow out that old loan, so we need to bring more equity into the deal to get that financing. And actually at this point, I'm not including the loan cost yet. So I'm going to come back in this formula here. I'm going to adjust minus, and then we'll take our loan amount times 1%. So that's like another 81 grand of refi proceeds we won't get. So that's essentially more equity you need to bring to the table. And then we need to do a payment calculation to figure out what our new monthly or annual debt service is going to be. The loan payment will do equals PMT. The rate is 6.75 divided by 12. The periods is 30 multiplied by 12. The present value is minus 8.13 million. We can leave future value blank, and then we'll multiply that by 12 to get our annual payment, and it's $632,772. And then we can calculate a DSCR. So we have our stabilized NOI, and then we'll just divide it by our loan payment, and we're at a 1.28. We're above a 1.25. We feel good that this would be approved and a lender would sign off on it. So now we need to create our cash flows down below, just as we did for the sale side, but for the refi. I'm going to put the years in first, and then cash flow. And then I'm also going to have a column dedicated to cash on cash. And then I'll just grab our initial equity investment right from column F. And now we're going to write our most complicated formula. Once we have it inputted, it'll be dynamic, and we're not going to need to change anything ever again. So bear with me. I'll kind of talk you through it as we're going. So we'll be utilizing the if formula again. And first I want to look at the cash flow before the refi takes place. So I'm going to say if the current year is less than the refi consideration year and lock that cell, then we just want to grab the distribution we manually entered in this gray section over to the left, and we'll leave that cell unlocked. We're going to hit a comma, and then we'll do another if. If the investment year equals the refi consideration year, and we'll lock that cell. Then we'll take that cash in refinance plus any positive NOI minus the new debt service. All of those cells will be locked. And then our value if false argument's going to be just if the investment year is greater than the refi consideration year. And if that's the case, then we're going to do a parenthesis, and we want to take the NOI, lock it, we'll multiply it by 1 plus our NOI escalator rate, lock that cell, and then we want to take that to the power, right? We're going to be increasing the NOI at 4% a year, and we want to factor in that compounding. So we'll do to the power and take the current year, which is H19 minus the refi consideration year. We'll lock it, close the parenthesis, and then we'll subtract out then the loan payment. So we're taking the NOI, increasing it by 4% per year. That compounding's factored in, and then we're subtracting out our fixed loan payment, locking that cell, and then closing some brackets. And then we'll drag that through year 10. And all of our cash flows from operations and that cash in refinance summarized nicely. We have one more formula we need to write for the cash on cash return. Our thought process is going to be similar to how we did it for the cash flow column. We need to think about this in 3 different time periods: pre-refinance, the year of refinance, and post-refinance. Also with the cash on cash, remember, it looks at the operating cash flow divided by the investment basis. Whether there's a cash in refinance, like the example we're looking at, or a cash out refinance, that's going to affect the denominator of the cash on cash equation. And we need to be sure our formula stipulates that in Excel. So let's once again start with an if formula, and we'll say if the current year is less than the refi consideration year, we'll lock that cell. And if that is the case, we'll take the cash flow of the current year, which is cell I-19, and we'll divide it by our initial equity basis, 5.4 million, and we'll lock that. Hit a comma, and then we'll nest an if inside of that. If the year equals the refi consideration year, and we'll lock that cell, then we need to take our projected NOI minus our projected new debt service, locking both of those cells, and we'll divide it by our initial equity investment, 5.4 million, minus the cash in refinance amount. We'll lock both of those cells as well. And then if the year is greater than the refinance year, we'll just take the cash flow divided by the equity, initial equity minus our cash in equity, locking both of those cells. We'll close some brackets, and then we can drag that formula down through year 10. Our model's complete. Now we can play with numbers and see how they impact both the sale and the refinance metrics. I think it's best to do this exercise months before you have to make the actual decision. The more time you have, the better, because things are going to be changing in the market, and you can come into this model and update things in real time. So let's say the property is maybe exceeding those original expectations you put out, and we wanna adjust the NOI, the stabilized NOI, to 900,000. You can see if we come down and first we look at the sales data, this project almost breaks even now. If we can sell a $900,000 NOI at a 6 cap, we'd be getting back almost 93% of our equity. It looks a lot more advantageous on the refinance side as well. With the increased NOI, we would get more financing proceeds. We'd get $9 million now, so that would mean investors would need to put less money into the cash refinance. You can see those cash on cash returns get much more lucrative later in the investment hold. Another thing we might want to adjust is the interest rate. The 10-year treasury has been dropping. I've been getting some emails from lenders showing that the risk spread has been decreasing, so interest rates are generally cheaper than they were a month ago for certain financing products. So if we want to change the interest rate of the loan to 6.5 instead of 6.75, you can see how that would impact the cash on cash return. You can adjust any of these brown input cells, and if you're comfortable in Excel, you can add your own analysis features as well. Unfortunately, I think a lot of investors are going to have to make some very difficult decisions in the upcoming year regarding their real estate investments. Having a process to interpret these choices will be paramount, and that's what this analysis strives to do. If you're a subscriber to our email newsletter, which is linked below, I'd be happy to send this over to you. You can just reply to your subscription confirmation email, and if you're already subscribed, you can reply to any one of my Friday emails that I've sent to you in the past, and I will gladly get this to you as soon as possible. If you've been enjoying Tactica's financial modeling tutorial content, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Thank you so much for watching, and I wish you all the best with your investment strategies. Take care.